So in trading, right, we have supply and we have demand. Now, if you say supply, what we are referring to is the point at which the market has enough energy to drop. That's a supply zone. Then when we talk about um, demand zone, demand zone is the point at which the market gain enough momentum to push upward, right? So let me open up the chart and I'm going to explain what I mean, what I've just said to you regarding supply and demand zone, right? So if you can see my screen, you let me know, please. You see my screen?
Yes, I can see your screen.
I can
Okay,
see it.
all right. So we're talking about supply zone. So let's talk about the supply. Now, a supply is, in the real sense of market world, if you are saying you are a supplier, it means that since you are the one that is carrying the goods to deliver to people, right? Whoever that needs it, that is supply. But in the concept of forex trading or crypto, supply is that point at which the market gains sufficient power to push down. So in the case of resistance that we saw the other day, we saw that resistance zone is the zone that prevents the market from pushing upward. Supply zone, on the other hand, is similar to resistance zone. However, supply zone has some few characteristics that makes it not to be resistant. So a supply zone is a zone that the market maker, the big institution, deliberately leave behind for them to use to what take orders. So let me take example from here. Let's look at this. This is a good example of a supply zone, right? So I'm talking about this point. This point. This is the area I'm talking about. So now the market pushed upward like this, as you can see. The market pushed to this point. This was the high of the market. Then when the market got to this point, the market dropped again, right? The market dropped again to this point. You can see it. So now, while the market was dropping, the market left something. While the market was dropping, the market left something behind. So if you look at this particular point, this point here, you will see that the market had what is called head and shoulder. Don't worry, you will learn about it, right? The market formed what is called head and shoulder in this region here. Now, after forming the head and shoulder, if we streamline it further, there is a supply zone right here. So this zone, this particular zone here is a supply zone. Let me just, yes, this one. This candlestick you see here, this candle, it's a supply. So now, this zone is a supply zone, and when the market, after falling to this length, the market rose again. Now, when the market rose to the supply zone, right, the market dropped, the market rose again to that same supply zone. It be the current price of the naira is let's say the naira to dollar is 1,600. and the institutions want to crash that price down to 1,000 naira, what they will do is they are going to increase the price. So when the moment they start increasing the price of that naira, what do you think they will start crashing the price? I beg your pardon. Now they will start crashing the price of the naira, and everybody that have their money saved in naira, what do you think will happen? They will start selling off because they perceive that the thing is crashing. The thing is crashing. So what they will do, they will start selling off. Then this zone that the institution started selling that particular pair, the point at which they were interested in the market is the supply zone, because it is these institutions that actually have the money to impact the market. So that zone that the institutions usually come to the market and pump money to either push it downward is called supply zone. So what we do is, okay, is there any supply? Then when we look at for the supply, we say, okay, we are going to wait for the market at that supply zone. So when the market returns to that supply zone, we are going to take our entry. And if it returns again, then we can decide to take entry or leave it, because now it's become, the supply zone is now becoming resistance, right? But that is how we identify supply zone. So in most other concepts, they will call supply zone order block. Other people will call it fair value gap. All of them, they are zones of supply or demand. Whether you call it order block, whether you call it fair value gap, any name they call it, it is actually a supply or a demand zone. It is that when you say a fair value gap, what do you mean? It means that this market has a gap in price, meaning that the momentum the market used to move is too much, such that it left a gap behind. So that price difference must be filled for the economy to be balanced. Therefore, we expect the market to come back and take the orders of those the order of those who placed order at that point that the market was unable to fill because of the momentum. Then we now call that particular point a supply or a demand zone. So this one is for supply. Supply is when the market is going downward. Then let's look for a demand zone. Now, let me delete everything here so that we redraw them again. You can see. Our chart, right? And if we look at this chart very well, we are going to be seeing some few things. Let me zoom it. Let me zoom it again so that you can see. So now we saw something here. The market moved this way. This was a serious move, and the market moved down to this direction, this point. While the market dropped, the market started moving upward. But let's demand zone. Now, if we take a close, let me draw something for you. So let's say this is our candle. I'm going to do this now. Let's say this is a candle, right? Remember, the market moves. Okay, let me use this. Remember that the market moves in this direction, right? Market moves like this. Market just like this, right? Now, why the market is moving like this and in this direction that you are seeing? Remember that this represents many candlesticks. This retracement is also candlesticks. This one is candlestick. This one is candlestick. This one is candlesticks, right? So all these candlesticks that you are seeing, all of them that we can see here, each of them is a candlestick. Sorry. Each of them is a candlestick, which represent this move, right? So you can see that the market moves in waves. So we have this wave, the market moves like this, came down, moved. So you can see the market moves in waves, right? It's not a straight line stuff. The market moves in waves. Okay, so the market will just keeps moving like that and so on. Now let's look at some things. Why the market is moving in this direction? Some candles are big, others are small. Some are thick, others are tiny, right? Now, you want to be paying attention to, in order for you to identify your demand or your supply zone, you want to be paying attention to the behavior of the candle. If the candle moves in such large volume that it leaves a gap behind, gap meaning that, look at this point, you will see that there is no gap in between these candles. You see that this candle came down and this one first moved to cover the body of this candle and dropped. So each of them are covering their bodies and moving. So let me look for example of what I mean by this for you. At the point where the market had an impulsive move, in this case, this is a point this market had an impulsive move downward, right? So this is the point. Now the red candle that caused that impulsive move is this one, right? This one here. Let me draw it to the board complete like this. So this candle that had this impulsive move, the first red candle that had this impulsive move, we can regard to this place as our supply zone, right? So what we want to do is we want to look at this place because this is the point that the market moved with so much power that it dropped, and it was dropping with fat candle size. You can see it, BB candle size. That's what it was using to drop. So this point is a supply zone. That's why the pressure is that high. So because it is a supply zone, we want to wait for the market to return to that zone before we take entry. Why? If the market moves with so much power like this, there are orders in this zone that the market did not feel. So because the market did not feel all the orders, it's going to come back to take out those orders again and come. So when we identify it like this, what we are going to do is put our entry at this zone, or we wait for it. When it gets here, we take our entry. So when we put our entry at this zone here, then we are going to be targeting this bottom zone as our take profit. So you are going to be targeting this downside as your take profit, right? Now you can see that if you have taken this entry from here, this is the point you would have gotten your take profit and out. You see it now. So you want to be making sure that your entries are usually at the supply or the demand zone. So this one is for demand. You see that the red candle that caused this strong move, when the market returned to that place, the market also had another strong move downward. So let's look for a green candle that caused such impulsive move as well. So let's look for it. Let's scan the market and look for one. We haven't seen anyone yet, so let's see. Let's keep session. Okay. Impulsive move, no impulsive move, no impulsive move, and there was impulsive move here, right? Okay, we have one impulsive move here. By impulsive move, I mean 3 consecutive fat candles that did not have any red candle in between them, right? The same thing for downward. You see this one, 3 consecutive red candles without any green candle in between them. So you can see them, even though this one was a bit small, but this place, this particular zone becomes your supply zone. And you can see that the market came, got to that zone and also dropped, right? And even though it went above it a bit, this is what we call stop loss hunt. You will learn it in the course of the class. It's called stop loss hunt, and you also learn how to prevent that hunt. So this point, this candle, this green candle here, you can see this green candle that I'm drawing. You can see that this green candle, let me complete it to the week. Now, this was the last green candle that have before this, that gave birth to these 3 impulsive move upward, right? So what we want to do is every time we see an impulsive move like this, we want to wait for the market to return to that zone that the impulsive move started. And in this scenario, this is the zone the impulsive move started. So, and when you are waiting for the market to get to that zone, you want to make sure that your take profit, if you are taking any entry, your take profit should be the top of where this move stopped. This impulsive move that went up. When you wait for it and it return to take the next orders, you want to make sure that your take profit is at the top of where this move stopped, right? So if you can see that the market came down to that same point, it touched it very well. And if you take your take profit at this zone to that hitting out, the market also returned to that same zone and went again, took out all the other entries, and then it came down again, and this time around broke above it a bit. This is also stop loss hunt because it has no reason to have done that, but stop loss hunt, trying to take out all the stop loss of the people that are here, then going up again. So you can see this is how we identify our demand zone, right? So a demand zone is identified when you see impulsive move, and this impulsive move leaves fat candles that have not been filled by a red one. So a
Please,
red
I
candle
missed.
is supposed to come back.
Hello. Sorry, there was a point where I missed. My network was bad. When you were
Oh, okay. No,
explaining the points where you set your entry at the peak of the impulsive move, I think around that area. I didn't get what you said.
okay. Okay, I will explain. So, like I was explaining, I said if every time we see an impulsive move like this, we want to wait for the market to come to that point where the impulsive move started, right? So in this scenario, you can see that we cannot take here as our impulsive move because this was just 2 and a red candle intercepted it. We cannot take this 3 because the candles are not fat and there is no gap in between the candles. And we cannot take this one either. Why? Because this one is just 1. There was no other one to complete it. And you can see there is no point here we can say this is a supply zone. So if we want to take any entry here, we are going to wait. You can see that the market is in kind of a range at this point. You can see this point, the market is in kind of a range, right? Not giving us highs, not giving us lows. So the market is in a kind of range at this point. So we are not seeking to take entry yet. We are waiting to see what the market will do. So if the market should give us an impulsive break upward, then we are going to wait for that point where the candle that caused that impulsive move, that candle that caused the impulsive move is called demand or supply, depending on the direction. So let's take the market, or let's look at another trail. This is Bitcoin now. Let's look at Bitcoin, right? Okay, great. So let's look at, let's take some examples from Bitcoin. Let's scan the market a bit. Okay. This Bitcoin have been in a range for a very long time. Okay, this was our previous explanation. Let me delete it. Okay. Let's see. Positive move, impulsive move, impulsive move. This was an impulsive move, but it did not complete it. This was a good, this is a good example. We have 1, 2, 3 impulsive move, right? So let's go ahead. This is the red candle that caused the impulsive move. Sorry, not here. Think on this side. So this is the red candle that caused the impulsive move, right? This one. So when the market drops like this, what we want to do is to wait for it to come back to this inside this candle. And when we do that, we are going to wait for it, this candle that caused this impulsive move downward. When the market returns to it, you can see it did what is called stop loss hunt, because the reason why the market always does this stop loss hunt is if your entry is around here and you take profit at the feet of this, the peak of this move is supposed to be above this candle. So the market makers, they understand that many people's stop loss are in this zone. So they are going to use the candle to come up wick it down until they clear all the stop loss in that zone. It's called stop loss hunt, right? So they will hunt your stop loss until you are out of the market. So for that, you learn how to avoid stop loss hunt. So now you see that if we have taken this entry at the middle of this place, we would have gotten a sweet 1 to 2, right? 1 to 2, and we are out. The same, that is how you trade with supply and demand. So like I was saying, Debbie, I said every time you identify a supply or a demand zone, and remember that this supply or demand, this point that we identify 1 to 3 strong move, then the market, we expected the market to return to it and drop again. Now this is the peak where this move that we identify our supply zone. This is where the move ends. This move ended at this point. So your take profit should be to be on the safe side and to be sure that yes, you are going to be hitting TP 90% every time you take entry. 90% you are sure to get to your TP. You want to make sure that your TP is at the point where this impulsive move stopped. So if the move stopped here, this is where our take profit is going to be, and we are going to take our entry right when the market returns to this particular red candle that caused the move. So if the market returns to this point, we are going to be taking our selling order. So the market returns to it, and we took our sell order. Sorry, we took our sell order, and then our take profit around here, this point. Then we have our stop loss just a little above it. I will show you how to calculate stop loss. It's part of our risk management, how you can prevent this stop loss hunt and not get your stop target. Because most times the market will clean your stop loss and still get to your take profit, and you'll be having heartburn. Your heart will be pulse, but there's nothing you can do because the trade has gone against you. Okay, so you see that we marked this fat candle that caused this move, and we waited for it. Then we took our take profit at the feet where the move stopped. So the market returned, took our order and returned. So this is a 1 to 2.7, meaning that if you are risking $5, you will be making around $12 or $13 from this trade. You see it now. So this is example of a supply zone, right? So now let's look for a demand zone. You will see how accurate it is if you are disciplined enough to trade from how is it called, demand zones. So this one is also a supply zone, so I'm not going to use that. Looking for demand. Okay, so this is not the best example, but we have this, and this one was a bit short-circuited. It's not full enough, but we can still use it because, okay, so we have this.
I have a question.
Hold on, you asked a question. Just hold on.
Can you hear me?
You will ask your question. Hold on. So now you see this point, this green candle, it was the last candle before this fat move, right? So now what we want to do is we want to mark this zone and wait for the market to return to it. So when the market returns to it, we want to take our entry, and our take profit is going to be when we take the entry at this zone, right? We take our entry at this zone, the take profit is going to be either we take our take profit here, where this line, where the move stopped, right? So this is the point the move stopped. You can take your profit from here, like this, and your stop loss will be just a little below the this zone. And this one, you can see that it's not much, just 1-to-1. Meaning if you risk 50, you are going to make 50. But you can also take this trade as high as this zone, right? Up to this zone. So I'm talking about this zone because this is one single move. From here to here is one single move. So you can also take this, and this will give you 3.5 return for every trade, for any amount you risk. So this is another example of what this is a demand zone. And you notice that when the market came to this point, it was rejected. The market dipped to take out all the stop losses that are here and started returning. So this market we keep going until it gets to this take profit, and you are good to go. So that is how you identify your demand and your supply zone. Now, ask your question.
My
Maybe ask your
question is,
question.
yeah, my network is really bad, so I'm disconnecting and connecting at my end. But my question is, now this market is more like an already made market as it stands now that are using to do this teaching. What if in a case where practically now live you are doing the market, checking out for the supply and demand zone? Is it at what point like that impulsive move, at what point are you going to know that okay, this market is still going to go down for you to now take your entry at that place? That's that first big candle. Let's take the red candle for example, the previous example you used. The first candlestick came down. It was from that point you took your entry. How are you going to know now at when you are doing your live trading that this candle is not going to go back up? It's going to go down. That is going to create another candle again. I don't know if you get my question.
Okay, to answer your question, I'm going to stop sharing the screen and show you something else so that you will understand better what I want to explain to you. So just give me a
Okay.
few minutes to load it up. Yes, let me load it up. You are still seeing my screen, right?
Yes, I'm seeing
Yeah.
your screen.
Yes,
Okay.
yes.
Okay. So, to answer your question, Debbie, you said in a situation where the market has not played out, because this one we are using market that has already played out to do our example. Now, in a scenario where the market is yet to play out, how do you now identify that this market is going to continue going up or it's going to come down and all that. That's your question, right?
Yes, that's my question.
Okay. So let's say this market right here has not played out at all, and we have the first impulsive move like this, right? So the moment this impulsive move happens, then we are actually not. So let's say we have the first candle. Let me draw it. Let me use this to illustrate. So let's say we have the first candle like this, right? Then we have another one like this. Then we have another one like this, right? Okay, let's put them together. So let's say these are three consecutive moves, right? Now, if all these are green candles going upward, this one is the first one that started this move. You understand? So you are going to take your whatever you used to mark and mark out this zone. So this zone that started the move is the zone you are going to mark. So when you mark this zone, you are going to wait for the market to play out and come to this zone. So it is when the market gets to this zone that you want to take your entry, right? You want to take an entry from this zone, and your take profit is going to be this last zone here, and you are going to just take stop loss a little below it. So you take your take profit at this zone, stop loss a little below this point, and your entry at the middle of the zone like this. So this is what you are going to do. So whether the market has played out or not, the moment you see 1, 2, 3 impulsive move in the market, you mark out the one that started that impulsive move. So you mark it out. Now, when you mark it out, you are waiting for the market to return to that zone. And when the market returns to it, you are going to now take your entry at that point and target where this move stopped. So it is where this move stopped that you expect the market to get to. Then you put your stop loss below it, give it a little gap because of stop loss homes, and you watch how the market will play out and to your take profits, right? So now I want to use a real life example for you, a real life example. I'm trying to load it up, so hold on. Mute your mic. Okay, can you see? Okay, I've not shared this. You can still see my screen, right?
No,
Huh?
no, no. It's yes,
No.
yes.
Yes, you can see
Hold
it.
on. Let's hold on.
Hello.
Yeah. I think my screen is confirmed. Can you see the screen?
Yes, I can see your screen.
So this is market that we want to use to check, right? So we want to look for our supply and demand zones in this market. So let's watch. Important. So, as you can see, the market gives us these three rules, but they are not fast enough. Same thing happened here, but they are not fast enough, right? So let's keep watching. Now, did you see what happened? I have 1, 2, 3 positively. You are seeing it, right? Now, remember that this market has not played out in anything. This is an positive move that has happened 1, 2, 3. So we are going to take our running tools. We are going to now mark out this candle, the rule of average candle that gave them the positive move. Now, what we are looking for is we want the market to return to it, that we take an entry, and anywhere this move stops, here we are going to take our profits. So let's keep watching. I want to take our entry, right? We want to take an entry at this point that the market returns to it. And we want to set our stop loss above this point so that we don't get stopped out. And our take profit is going to be just below this point here. So you can fine tune your stop loss a bit if it's too bad. Let's just leave it and watch what happens. Now, you see, this one failed, right? Because our stop loss has been hit. But you notice something that as soon as the stop loss was taken, the thing came to the take profit. Right? So this big candle is our first new zone, and we can take an entry when the market returns to this point. So the moment the market returns to this point,
But then this other side have not been formed. So the market returns to this point, which is this one. And you can see that the market entered, cleared out everything, and then beat back inside. It didn't close outside, it closed inside. But this was manipulation to clear out all everybody that have their orders in this environment and also take some pending orders in this environment. That was why you saw this bomb. However, when the market finished doing that, and went back in. So if you want to take an entry at this point, you have taken it when the market returned, then you can take your stop loss and target this stop. But this is a risky trade. It's a risky trade because your safest stop loss will be below this point. But if you are trading with that, you won't make much money. But if you want to take the risk and trade like this, but this is a risky trade. So what I'm trying to explain to you, because there are other things you need to consider before you take an entry, right? You don't just see your other block or your supply zone and just take an entry. There are other things to consider. But what we are learning in this class is identifying. So this one was a win, see. Then it was a narrow escape from the stop loss. So this was the win. Smart and take profit. So this one would have recovered the loss we had and even giving us extra profit. So that's trading is. That's why risk management is best friend when it comes to trading. However, what I'm trying to explain to you, when you see your other block supply zone or your demand zone, there are other parameters you need to put in place depending on the kind of strategy you use in trading. What I'm trying to show you here is that you don't need the entire market to come out before you can take an entry. The moment those conditions are met, you can take the entry and wait for it. I don't know if you are understanding what I'm explaining.
Yes, so I understood, but I still have a question I wanted to ask before.
We have another move here, which is strong move to the downside, right? Now, this move, we can wait for the market to return to this move and take our entry. So let's see what happens if that is going to happen much more. Why the market is going to give us another move, you can see give us possible, and we can also draw out this and this. So this one is the risky one, but this is the valuable. This one is the risky one. We are going to say trade all of any of them. You need to know that even if you keep stop loss, one win top item. So let's watch. So the market has returned to this one, right? So we want to take our entry from there. And then this like I told you, this one is a risk. Reason why it will not hold because of this one. This one is the most valuable. Let's watch what happens here. So you see that after incidents are going to take profit. So the reason why that happens is another one that we not pay attention to. And you can see that expected this one, and after this one, then the market just so that is what supply and demand does. It gives the market enough energy to push down. And from here, you can see another one is formed. market, and so on. So just identifying the supply chain does not mean you must take entry when the market gets to that point. You understand? We are only learning how we identify our supply zones and our demand zone. You don't take your entry immediately you see a supply zone or your demand zone. There are other things you will need to check, and there are other things that you will need to. There is a way the market trend needs to behave based on your strategy that before you can say, okay, I'm taking this trade. If those things are not complete, even if the market got to your zone, they are not going to take that trade, right? So they are going to learn those things. Like you can see when I think this one was going to take it's actually finished because from what I can see, even if this is supply zone, there are parameters that are not met going to stand. So that is how you identify the supply and demand. So you can ask the questions now.
Yes, I have a question. I understood all what you said, but what I'm not sure about is talking about the supply zone. After you've identified your supply zone, is it a must that if you must enter into the market, must you sell? That's my question.
Supply zone is there, right? When we talk about supply, we are talking about value. But if it's a demand zone, then you buy. Okay, let's look for anyone that gives demand, right? So I'm going to get off this opportunity and leave. Then you can move back there. Let me explain. Let me use another chance to explain the question you just asked. Right? Let play this, right? Now, while we are playing this, what we want to do is to make sure that we want to identify demand. So in this time we are not doing supply. Supply is selling, demand is supply. So let's identify our demand tools. So let's see. We see this is possible in price, right? So we can say, okay, let's take this point as our demand zone because of this positive thing that took place. And there is a gap inside this new term because that we expect the market to come back, take all the orders from that gap, and then start moving up for the thing. So we are going to wait for the market here. You know, enter and get. So now we have the market come inside our zone. So we cannot take our entry and take our stop, take profit at this stop. And we put stop loss somewhere along the right and continue to beat when they start moving. Let's see what happens. enter the range, the moment you enter this can be very startling. Once your market enter range, the 50-50 chance for you. But I just want you to see that it's not only sell you can sell, right? It must not be a sell. If your zone that you have identified is a demand zone, then buy. The reason why we are selling the other time is because the zones we identified as supply zone. So if you identify the demand zone, like this one, just then you can take a buy. Unfortunately, this trade entered a range, and if your trade is in range, effectively you just need to know what to do with that on average. Right? This is an example of how you identify supply rather than demand. So now we are going to for another trade. We are going to look for another trade, right? Using to give our example. So let's look for it. Let's look for it. See that the trade actually because of the range. The range contains one to two. Okay, let's look at another supply demand zone. Let's
Hello, I can't hear anything, or is it just me?
It's not just you. Can't hear anything.
Over here too. It's like it's not.
Hello.
I think he's having